Hello everyone, guys. Last time we discussed about Unit 8, and in Unit 8, this name of unit is Corporate Restructuring, International Trade and Exchange Rates. So this is what we have started last time. In Unit 8, we have these topics. 8.1 is about merger and acquisition. 8.2 is about international trade. 8.3, 4 and 5, all these topics are relevant to exchange rates. So we started last time exchange rates, and we discussed in the last video we have discussed about like what is exchange rate and what is the direct quote, indirect quote. So what is spot rate, what is forward rate, how we calculate forward premium or forward discount in percentage. Okay, so how to adjust the spot rate for the forward rate if you are provided with the information of premium or discount. So if you have not watched that video, so please I will recommend you to watch that video first because it's a continuation of that. So here we go. We are still in 8.3 topic. So we are discussing today about exchange rate system. So here we go. So please remember we have four systems for setting exchange rates. Okay. First system is called fixed rates. Second system is called freely floating rates. Third is called managed floating rates. And fourth is called patched rate. So please remember this fixed rate, managed floating rates, and patch rates. So it has some similarities also. So don't mix it. So starting with the fixed rates first, like what is this system? So please remember under fixed exchange rate system. So what we will do, the value of one country's currency in relation to the other country's currency is either fixed or allowed to fluctuate only within a very narrow range. So let me explain what they are trying to say. For example, I'm just giving example. Let's assume Indian rupees is your home currency. Let's assume. So our home currency is Indian rupees, INR. Okay. And for example, I'm just trying to tell you that India has fixed, for example, it is not the practical case, but I'm just assuming. Let's assume India has fixed the exchange rate with US dollar. For example, this is US dollar, and for us, it is foreign currency. And I'm assuming here, for example, $1 equals 70 Indian rupees. Okay, this is what is the spot rate. Spot rate mean to say the current rate. Okay, today, the rate for today exchange. Okay, so $1 is equal to 70 rupees. And now here what Indian government will do, so they will either this fix this rate, or there is another part of the statement, or they allowed to fluctuate only within very narrow range. So narrow range is what? For example, $1 equals 70 rupees. So now what? The Indian government, they will set the limit. Limit is what? For example, the maximum rate can go down. Let's assume $1. I'm just giving you example. $1 is equals 65 INR. This is the lower limit. And the higher limit is, so $1 could be, for example, equal to 75 rupees. Now what? These are the ranges, narrow ranges, because spot rate is 70. So they have set the rate that it can go down up to 65 and go up to 75. Now what? In between these two ranges, the demand and supply will work. Demand and supply of the currency will decide the exchange rate between these ranges. But if the exchange rate will try to go below this range or above this range, in that scenario, what Indian government will do, so they will intervene. For example, central bank, so central bank will intervene. They will buy or sell the currencies, okay, to bring the rate back between these ranges, right? So this is what is called fixed exchange rate system. So for example, if rate is due to demand and supply, for example, this is just spot rate and these are ranges. For example, if due to demand and supply, rate is $1 equals, let's assume, 67 Indian rupees. So maybe government will not intervene. But if the rate is trying to be $1 equals 64 Indian rupees, right? So this is now it's going below this range. Now Indian government will intervene, the central bank will intervene, they will buy and sell the currencies in such a pattern that the rate will come back between these ranges. This is what is called fixed exchange rate system. And please remember this part of the statement is really important. Here the central bank or the government will allow the exchange rate to fluctuate only within very narrow range. Understood? Now the question is, so what advantages or disadvantages we have here for if you are using fixed exchange rate system? So a disadvantage is that the government can manipulate the value of its currency because central bank, you can say, or the government will intervene, obviously, right? If the exchange rates are going below or above the range, so they will intervene and they will try to bring the rate back into between these ranges. Now here this is a disadvantage, that the government can manipulate the value of its currency. And we have here advantage also. What is the advantage? For example, so here the one very significant advantage to a fixed exchange rate is, the advantage is that it makes for high degree of predictability in international trade, because the element of uncertainty about gains and losses on exchange rate fluctuation is eliminated. What it means, for example, if any country is trading with you, so obviously because exchange rates are fixed or it is allowed to vary within very narrow range, so obviously the country who is doing trade with you, so they are not vulnerable for the exchange rate fluctuations, right? So the uncertainty is removed, so they can predict, okay, so if they are importing or exporting, how much receipts or payments they have to make with certainty. This is what is the advantage of fixed exchange rate system. Now here we have example here. This is very practical example. So actually here the example is the pound, British pound. It was fixed against US dollar. Okay, from what 1945 to 1972, right? And what happened? So the more recently now, first I told you the pound rate was fixed against US dollar. Okay, but more recently was part of European exchange rate mechanism. It's kind of mechanism. So, and it was the part between 1990 and 1992. Like you can assume here, European exchange rate mechanism is one kind of authority. Okay, so you can just assume for the sake of understanding. So now what happened in 1990 and 1992? The rules of European exchange. Okay, European exchange mechanism were complicated. So the UK membership of ERM involved a target rate of 2.95 German mark, okay, or DM, which is the German currency, 2.95 marks against £1. So what they are trying to tell you, they are saying that from 1990 and till 1992. So what happened? The pound, £1 was fixed against what? Against German mark, okay, and the rate was what? 2.95 DM. Okay, so it means £1 was equal to 2.95 DM. But so they have with a plus minus 6% trading, plus minus 6% trading, plus minus 6%. It means what? It means it was kind of fixed exchange rate system. So the rate is what? Rate was fixed £1 to 2.95 DM. This is another example, okay? And here the first example I told you, pound was fixed against US dollar between this period, right? But between 1990 and 1992, so British pound was fixed against German currency, and this was the rate. £1 was fixed against 2.95 German mark. Okay, but there was variation plus minus 6%. It means what? It means 6% plus what? If you will add 6% into that, it means maximum rate could go up to, you can just add 6%. For example, 2.95, you can just multiply with 1.06. Okay, let me just tell you here. This would be the upper limit. Okay, maximum exchange rate can go up to this. So 2.95 times 1.06. Okay, so it means maximum rate could be what? 3.127. This was the maximum range. Now you can just take minus 6% from this rate. How you can do? So you can take 2.95, okay, multiply by 100 minus 6%, it will be 94%. So if you will just take it, so 2.95 times 94%. So rate, minimum rate could be what? 2.7. Okay, actually the rate, this was a rate which was fixed. 1 pound equals 2.95. But there was, a narrow range to just fluctuate, which was 6% plus minus. It means maximum rate can go to this and minimum rate can go to this. Okay, to this figure. So if rates are between this, government will not intervene. But if rates will try to go down or below this limit or above this limit, then government will intervene. So government intervention is there. Understood? This is what is the example for a fixed exchange rate system. Okay, now here we have here freely floating exchange rate system. What is a freely floating exchange rate system? Now please remember, in a freely floating exchange rate system, so only the demand and supply of the currencies will decide the exchange rate. So government will not intervene. Okay, so that is called what? Freely floating exchange rate system. So in a freely floating exchange rate system, the government steps aside and allows exchange rates to be determined entirely by the market forces. Market forces means say supply and demand of the currencies. Okay, for example, if you are living in India, let's assume, and you have to make payments in dollar, so obviously you need to buy a dollar, then maybe dollar demand can be created, right? So if you are receiving dollar, obviously you need to sell dollars, maybe then dollar supply can be created. So due to demand and supply, exchange rates will move. Here government will not intervene, so government will simply step aside, okay, and allow the demand and supply to set the exchange rate. So this is what is called freely floating exchange rate system. Now guys, here please remember here the disadvantage. What is the disadvantage here? The disadvantage is that a freely floating system makes a country vulnerable to the economic conditions in other countries, right? For example, like I'm just giving example. For example, if you are having a war in any specific country, obviously if it is freely floating, it's not properly managed. So what will happen? Obviously, exchange rate will fluctuate, right? Significantly. Another way, for example, if there is an economic recession, okay, in your economy, obviously if you are not managing the exchange rate, so obviously what will happen? So it will change with significant portion, right? So this is what is freely floating exchange rate system. Now here we have example how it works. Okay, freely floating. So just as example we are discussing here. So please remember, first I told you fixed exchange rate system, right? And now I'm explaining freely floating. So how it works, freely floating. The exchange rate between the USD, US dollar, and the euro, for example, fluctuates daily based on factors such as trade flows, interest rates, inflation, geopolitical events, and speculation. They are saying that here, government is not intervening between euro and US dollar. So exchange rates are changing due to the trade, okay, import exports, interest rates, inflations, geopolitical events, and speculation. Now here the next point: if demand for USD increases, for example, maybe we need dollars to make payment in dollar. So obviously dollar demand will be created. Okay, due to it could be one thing, maybe why dollar demand is created. For example, maybe we need to make payment in dollar. Let's say I'm living in Europe and I want to buy a dollar to make payment in dollar. Okay, obviously to make payment in dollar I need to buy dollar. If I have to buy a dollar, obviously dollar demand will be created. Right or wrong? And in this is the first scenario. Other scenario is what? Other scenario is that, for example, in USA, interest rates are higher. If you will invest, maybe you can get more interest. So what you will do, if you're living in Europe, so and you think that in USA interest rates are higher, so you have an opportunity to earn high interest or high income. So what you will do, you will sell euro, you will get dollar, and you will invest over there. So again, dollars demand will be created, right? And obviously if dollar demands will be created, so dollar obviously will rise in value or dollar will appreciate in value, right? On the other hand, if euro demand is created, let's assume now you are living in USA and now you have to make payments to the European company, okay, and you need to buy euro, and if you have to buy euro, obviously euro demand will be created and again euro will appreciate. So this is very simple rule: whichever currency is in demand, that will appreciate in value. Okay, mostly it is happening. But in freely floating, the main point is what? The exchange rate will be decided by only the demand and supply, which is called market forces. Understood? So now we have here another third exchange rate system, that is called managed float exchange rate system. Please remember, majority of the countries, they try to use this system, managed float exchange rate system. Okay, now here you have to remember what is the difference, because mostly people, they will mix the managed float exchange rate system with the fixed exchange rate system. Don't mix it, because I told you, in the fixed exchange rate system, exchange rate is fixed, but it is allowed to fluctuate. However, exchange rate is fixed. However, it is allowed, it is allowed to fluctuate within very narrow range. It is allowed to, it is allowed to fluctuate within very narrow range. Within narrow range. Okay, this was the fixed, but here in the managed float exchange rate system, again, rate you can, in the managed exchange rate system, what will happen? So the government will allows, for example, I'm just assuming here, let me give you example first here. Okay, for managed now, it's a managed now. For example, today rate, this is spot rate. Let's assume I'm living in India, for example, $1 equals 70 rupees INR. Okay, now here government will set the lower and upper limit, and lower limit is what? For example, 55 INR, like $1 equal 55 INR, and maximum range is what? $1 could be, for example, 85 Indian rupees. Now demand and supply will work. Okay, if exchange rates are, this is the lower range, this is the higher range. Now if the exchange rates are fluctuating between these ranges, government will not intervene. Okay, government will not intervene. But if the rate will try to be lower than this or more than this, so then again government will intervene, or the central bank will intervene. They will buy or sell the currencies. Okay, in such a way that exchange rate will come back within this range. Now here, what is the difference between managed floating and fixed floating? In fixed floating, the range was very narrow, but here the range is little bit wider. Okay, range is little bit wider. And what is the similarity? In fixed rate, obviously government will also intervene, and even in the managed exchange rate system, government will also intervene. I mean to say, your financial institution like a central bank will intervene. They will buy or sell the currencies to bring that rate back between these ranges. Okay, this is what now we will go through a managed float exchange rate system. They're saying in a managed float exchange rate system, the government allows the market forces. Market forces means demand and supply to determine the exchange rate until, generally market forces will decide the exchange rate, demand and supply, until they move too far in one direction or another. As I told you here, range will be wider. The government will then, obviously, if the rates are going beyond the ranges, so the government will then intervene to maintain the currency within the broad range. Here, range is broad. Okay, considered appropriate. So this system is one currently in use by the major trading nations. Okay, so that is what is called managed float exchange rate system. As I told you, this is widely used by the countries. Then here, what's the advantage? So don't take this discussion light, because we'll go through the questions, so you will get idea how tricky it is. Okay. So what is the advantage now? So the advantage of managed float is that it has the market response nature. Obviously, market forces are there, or it has the characteristics of freely floating exchange rate, like demand and supply will decide. So this is what they're saying. It has the market response nature of a freely floating system, while still allowing for government intervention when necessary. Right? So here, what is the criticism of the managed float? The criticism of the managed float is that it makes exporting countries vulnerable. Okay, like especially those countries who are doing trade with you, right? So for them, risk is high. Okay, how the risk is high, especially those countries who are selling goods to you, right? So risk is high are those countries, even maybe who are importing goods from you, any country who is doing trading with you. So it is more risky for them, right? Because the exchange rate may change sudden due to demand and supply, and they may have they may have losses on their transactions, right? So this is what is the criticism. Okay, and one more thing here, they are saying that why it is, criticism, because it will make it will increase the risk for those countries who are trading with you, because because due to the lack of self-correcting mechanism of freely floating system, because we have some features of freely floating, but it's not accurate, right? So we don't allow whole demand and supply of the currencies to decide exchange rate because government intervention is there. So here we have a real world examples. For example, just example, suppose that Indian rupees is trading at 80 INR equals 1 USD. For example, assume $1 equals Indian 80 rupees. But due to global uncertainty, there is a sudden drop to 85 INR equals 1 USD. Like previously it was what? $1 equals 80 Indian rupees. Now what happened? What may happen? For example, $1 may become, for example, 85 Indian rupees. Now what? Okay, so the RBI might sell reserves, because if exchange rate will fluctuate, obviously now the central bank, you can say, they might sell foreign reserves like USD and buy INR to increase the demand for rupees. Like what they will do, because here Indian currency is depreciating, right? Because previously you can buy $1 by paying 80 rupees, but now you have to buy $1 by paying 85 rupees. It means here Indian currency is depreciating. Whenever Indian currency will depreciate, so what will happen? Now government will intervene. What they will do? They will sell dollar in the market. They will sell dollar in the market. If they will sell dollar in the market, obviously once they will sell the dollar, so obviously then dollar will depreciate, right? And automatically there will be appreciation in the Indian currency, right? This is how government they can intervene. This is what I'm saying, that. So please, this is what is the managed flow trade, but there is advantage. Advantage is that if you are managing it, so again, if you are properly managing, right? So again, it can remove certain kind of risks also, right? If you are managing properly, but still there is a risk because it has feature of freely floating exchange rate system. Now we have a last one, and people also they are also mixing the pledged with the fixed rate. Don't mix it. In fixed rate, what? Rate was fixed. Rate was fixed, but it was allowed to vary within very narrow range. Okay, due to demand and supply. But if the exchange rates are moving beyond the ranges, then government will intervene. That was fixed. But what is patched? Pledge exchange rate system, you can say it is more authentic form of the fixed. So, but in pledge, what? Rates are fixed here. In a pledged exchange rate system, a government fixes the rate. Rate is fixed for its currency with respect to other country currency or to the basket of several currency. Like you can, like for example, Saudi Riyal versus US dollar. It is fixed rate, right? Similar way, UAE dirham is fixed against what? Against the dollar, right? Uh, okay, if the market forces will try to change this rate, so government will intervene. Intervention is also here, government will intervene, but here overall rate is fixed. Okay, so for example here, rate is fixed. As I give you example, I gave you example already. For example, Hong Kong. Okay, like Hong Kong dollar is pledged against US dollar at a rate of 7.8 Hong Kong dollar with 1 USD. This is the fixed rate. Another example, another example. Okay, uh, Saudi Arabia, for example, Saudi Riyal is patched to US dollar, because there is a high quantity of trade between Saudi and US, because Saudi is exporting oil, right? And Saudi is also buying some, you can say, army related equipment from the US. So there is a heavy trade between US dollar and Saudi Riyal. So rate is fixed, and this is the rate which is patched 3.75, okay, equals $1. This is the fixed rate. So this, obviously, if the rate is patched, so this will provide stability, especially for oil exporting economy. Okay, and because oil prices are denominated in USD, right? So this is what is the fixed. But if, as I told you again, I'm adding additional point. If even the rate is fixed, sometimes speculators, they will try to do something in the market, and they may try to change the rate, but rate is fixed. Still, government can intervene again here. They will sell foreign currency or local currency to to just eliminate those temporary fluctuations. Okay, so this rate, this is called fixed. So you can assume this is the more authentic form of fixed here. Rate is fixed, that's it. This is what is patch system. So I told you four exchange rate system. Okay, so one was managed float rate, the first one was fixed exchange rate, then freely floating, then managed float, and then we have patched system. Now we have here question here, so please remember, try to understand this question. So they are saying that in a foreign currency market, because in currency markets, demand and supply will be created and exchange rate will change. The phrase managed float, do you remember managed float? If you will just go back, in managed float, I told you already, if you will just go back and check it, what was the managed float rate system, because you have to remember this. So here government will allow the market forces to determine the exchange rate until they move too far in one direction or another. It means here range was wider. Okay, range was wider. If the exchange rates are between the range, so no problem. Government will not intervene. Demand and supply will work. But if the rates are trying to go beyond the ranges, so then government will intervene, right? And here it was bit broad range, right? Broad range. This is managed float. Now we'll go back to the question. They are saying that the question, if in a currency market, the phrase managed float refers to the I think so. Managed float is also called dirty float, guys. Please don't forget if I'm not wrong. It's also called dirty float system. Okay, dirty. So they're saying that in foreign currency markets, the phrase managed float refers to what? Refers to the necessity of maintaining a high liquid asset. No, it's not about liquid asset like gold, okay, or conduct international trade. No, it's about only exchange rate, right? Rate price of two currencies. It's not about liquid assets, so it's incorrect. Again, managed float refers to the what? Tendency for most currencies to depreciate in value. No, it's not only for depreciation of the currencies. No. Okay, we try to maintain the rate between wider range, between broad range. This is also incorrect. Three, see, now see, again, the managed float refers to the fact that actual exchange rates are set by private business people. No, not by private business people. Rates are decided by demand and supply or market forces, but government will intervene if the rates are trying to go beyond the ranges. So this is also incorrect. Okay. So then D, discretionary buying and selling of currencies by central bank. Yes, this is correct. The reason is that first we will allow the market forces such as demand and supply to set the exchange rate. First we will allow this, but if rates are going beyond these ranges, government will buy or sell the currencies. Okay, it will be done by central bank, and they are doing discretionary. Okay, discretionary means it's their choice, right? So they can buy or sell currencies to bring the rate back between the ranges, right? So this is what is the correct answer. D is the correct answer. I'll show you a couple of questions, don't worry. So here we have here. Now, let me tell you, because this point is really important, although I explained in the last class as well, but I'm going to explain in this class also, because this will help you to solve a lot of questions, okay, which are conceptually based on concepts. Here we go. We are discussing now depreciation and appreciation of the foreign currency. Okay, let me just write it something here first. I'm saying that, for example, you are living in India, let's assume. Okay, so Indian rupees obviously is your local currency. So dollar, I'm assuming now it's your foreign currency. So $1 equals 80 Indian rupees. This is what is the normal rate. Now, what if the rate will move to this, okay, move to this, $1 equals 95 Indian rupees. In this scenario now, if the rate will move to this situation, that $1 is equal now 95 Indian rupees. In this scenario, what happened, guys? In this scenario, which currency depreciate, which currency appreciate? Here in this scenario, rupees has depreciated, because previously you were paying $80, 80 rupees to buy $1. Now you are paying $95 to buy $1. Okay, this is here, rupees is depreciated and dollar is appreciated. But if I'll change the scenario now, for example, now if $1 became 70 Indian rupees, now in this scenario, In this scenario, what happened? In this scenario, guys, Indian rupees has appreciation in value and dollar has depreciation. Obviously, if you know one currency has appreciated, other currency will always be in opposite position. For example, if Indian rupees has appreciation, so dollar will have now depreciation for sure. Okay, how? You can just think this, check this way. Previously you were paying 80 rupees to get $1. Now you have to pay only 70 rupees to get $1. It means Indian currency has appreciated and dollar has depreciated. So we are talking about here depreciation and appreciation of foreign currency, because this point is explained from foreign currency point of view. So it means here, if a foreign currency depreciates, this is a scenario, because here dollar is the foreign currency. Okay, dollar is depreciated. If a foreign currency depreciates, please remember the same situation can be written this way. If foreign currency depreciates means say, if local currency appreciates, again these two are the points. If local currency will appreciate, again this thing will happen, or if the foreign currency will depreciate, it will same, these two things will happen. That's why I told you appreciation of one currency means a depreciation of other currency. So here I'm saying that if it's starting point here, if foreign currency depreciates, like if foreign here in this scenario, if foreign currency depreciates, so it can be written if local currency appreciates, right? So here we go. If foreign currency depreciates, it is now worth less in your home currency. So what it means? Yes, it means here previously you are giving 80 to get $1. Now you are giving 70 to get $1. It means it is now worth less in your home currency, right? Dollar is worth less in your home currency now because it is 70, right? Okay, now what? Now think this way. If your brother is living in USA, but you are Indian, I'm assuming your local currency is INR, and he is sending you the money. It means you have now dollar receipts, right? Receipts in dollar. Another way, if company is selling goods, if you are Indian company, you are selling goods to the USA, right? Obviously US company will pay you, right? And they are making payments in dollar, so it is good for you if the rate will move this way. Previously it was 80. For example, you made a sale of $1,000. It means you have a $1,000 receipt of $1,000. Now tell me, what is better for you if you are living in India? 80 rate is better or 70 is better? 80 is better, right? Because you will sell $1,000 because you have a receipts of $1,000. If you will sell $1,000 at 80, so you can get 80,000 Indian rupees. But if rate will move this way from 80 to 70, now you will get only 70,000 Indian rupees. So is it good for you or bad? It is bad. So this is what they are saying, the first point. They are saying if you have a foreign currency receipts. So if foreign currency will depreciate, it is adverse movement for the receipt. It's not good because now it will worth only 70,000 instead of 80. Right? So if whenever foreign currency depreciates, for receipts, it is adverse movement because we will receive less in your home currency now. Right? Because you are receiving 70,000 only in your home currency. But now think this way. Now let's say your brother is studying in USA and you are living in India, and now you are sending his pocket money every month. What do you want? Do you want to buy $1 at 80 or you want to buy $1 at 70? Definitely you want this, right? It means if foreign currency will depreciate, so this is better for you if you have to make payments. For example, you have to make payments of $1,000 now. So it means $1,000 you need to buy now, right? You need to buy now, and it is good for you if foreign currency will depreciate because you can buy this 1,000 at 70 only, right? So like you just need to pay 70,000 Indian rupees to buy this 1,000. But if rate is 80, so then you have to pay 80. So what is better? So now I'm just summarizing here. The summary is whenever foreign currency whenever foreign currency depreciates, okay, if there is any depreciation in the foreign currency, if you are receiving foreign currency, it is bad news for you. It is adverse movement for you. But if you have to make payments in the foreign currency, it is a good news for you. It will become a favorable movement for you. Understood? Okay. Okay. Now we have here another here. We have another example. What if this is the second scenario? The first scenario I told you, what if the foreign currency depreciates? Now, just let's change the scenario. Okay, let's change the scenario now. Now, what if a foreign currency appreciates? Okay, again, your local currency is Indian rupees, and let's assume this rate is there. $1 equals 80 rupees, Indian rupees, INR. Okay, now what if the rate will move? What if the rate will move to this direction? $1 becomes 90 rupees, Indian rupees, INR. So it means here now this current, because previously you were paying 80 rupees to buy $1. Now you have to give 90 rupees to buy $1. It means Indian rupees has depreciation and dollar has appreciation. So this is what is written here. If foreign currency appreciates, this scenario. Foreign currency appreciate means it can be written this way: if local currency depreciates. So same result will be there. If local currency depreciates or if foreign currency appreciates. Okay, the same scenario will happen. So what will happen here now? If foreign currency appreciates, so if you have a proceeds of foreign currency, for example, you have received $1,000 and foreign currency has depreciates, it is good news for you, because now if now you can get how much? 90,000, because $1,000 time 90, so you can get 90,000 in rupees. It is good news for you if foreign currency appreciates, right? For receipts, it is good news. It's a favorable movement if foreign currency appreciates. But if you have to make payment now, think for example, now you have to make payment of $1,000. If you have to make payment of $1,000, you need to buy $1,000. What do you think? Do you want to pay 90 rupees to buy $1, or do you want to pay 80 rupees? Definitely you want to pay 80 rupees, not 90. But if rate will move to 90, it will become bad news for you, terrible news for you, shocking news for you, right? So this is what they're saying. If foreign currency appreciates, for the foreign currency payments, it is a adverse movement, because you have to pay more your local currency to buy foreign currency. Understood? So this is what is the local currency depreciation and appreciation. And here we have a summary now. I'm just showing you summary here. You can just remember this way also. So this is what is the effect of exchange rate fluctuations. Okay. Whenever I will use the word gain, it means it's a favorable movement. Whenever I will use the word of loss, it means we can treat as adverse movement in the exchange rate. So here we go. Here we have here transaction that will be settled in a foreign currency. Okay. What it means? For example, you have made sales to US customer. I'm assuming that you are living in India. Okay. So you have made sales to the US customer. Okay. Obviously now you will receive dollar. Dollar is your foreign currency. You will receive dollar. And if foreign currency appreciates, if foreign currency appreciates, it is good news for you. Okay. If foreign currency appreciates, it is good news for you. Why? For example, let's assume rate has moved from $1 to 80 rupees. This was the rate previously, $1 equals 80 rupees. Now foreign currency appreciate means say $1 equals now 90 rupees, 19 Indian rupees. It's a good news for you. It is good news for you, right? If foreign currency appreciates, so now you will have a gain, because you have to sell dollar to get rupees, because it's a receipts in dollar. But what if the foreign currency depreciates? It means rate is moving from $1 to 80 to $1 to 70. So then it is bad news, because you have receipts in dollar and now you want to sell dollar and you got only 70 rupees against dollar. So here that you will have a transaction loss. So please remember, if you have a foreign currency receipts, now you can remember this way. If you have a s- sales, will always sales or export, anybody can use in the question. Export would result always in receipts of foreign currency, receipts of foreign currency. And if the foreign currency will appreciate, you will have a gain. If foreign currency depreciates, you will have a loss. Can I say this way? Exports means a foreign currency receipts, right? I can say this way also. Foreign currency appreciate means a local currency depreciate. If local currency depreciates, you will have a gain. Or and foreign currency depreciate means if local currency appreciates. I can say this way also, right? If local currency appreciates or foreign currency depreciates, you will have a loss. But now here, please remember here, for purchases. Obviously, when you buy goods from foreign country, so then purchases are also written, can be written as imports. Obviously, when we import the goods, so it means we have to make payments in the foreign currency now, right? payments in the foreign currency. You have a payable denominated in the foreign currency, right? Due to the import of the goods, right? So you have foreign currency payments now. So where you will get a gain or loss. Let's connect the information again. So please remember, if foreign currency will appreciate, what will happen? Foreign currency appreciate means if local currency will depreciate, what will happen? Here you will have a loss because you need to buy foreign currency. And now you would pay more Indian rupees to buy foreign currency. This is what is foreign currency appreciation, right? You have to pay more Indian rupees to buy dollar. So this is what is foreign currency appreciation or local currency depreciation. So here you will have a loss. What if you have a foreign currency receipts and foreign currency depreciates means if local currency appreciate. Here you will have a gain because you will pay less Indian rupees to buy a dollar and those dollars you will make as a payment, right? So here you will have again foreign currency depreciate. So please remember, memorize this chart carefully. If I have explained the logic as well, but if still you are not able to memorize the logic or to understand the logic, sometimes we need some shortcut. So the shortcut is then memorize this table when you would have gain, when you will have loss, when you could have loss or gain on receipts or payments, please. Okay, so now I'm going to show you some couple of questions. So here we go. Okay, so here we go, guys. So first of all, if the dollar price of the euro. Okay, please remember if this statement you have to understand if the dollar price of the euro rises. So please remember here, whenever its statement is written like that, that dollar price of the euro rises. It means here you can off the euro means a euro you have to keep one. Okay, this is sign of euro, sorry. Okay, so you have to keep 1 euro and dollar price means say the euro price is expressed in dollar. For example, 1 euro equals $1.5. Okay, which of the following occur now? Please remember, let's assume this is the normal rate, 1 euro equals $1.5. So the question is if the dollar price of the euro rises, so you have to increase the price. This is, let's assume, normal rate. This was normal rate, but now what is spot rate? This was the past rate. Now spot, what happened? So 1 euro became equals to $1.7. Now see, dollar price has increased, right? as com okay, from 1.5 to 1.7. This is the question now. If the dollar price of euro rises, okay, dollar price has increased, which of the following will occur? So what will happen? Tell me here in this scenario, just tell me in this scenario. Previously, let's assume you have to give $1.5 to buy 1 euro, right? Previously. But now you have to give $1.7 to buy 1 euro. So tell me, dollar has depreciated or appreciated? Obviously, dollar has depreciated and euro has appreciated. So they're saying that if dollar price of the euro rises, okay, so which of the following will occur? So dollar has depreciated and euro has appreciated. We have to search now. The dollar depreciates against the euro. Yes, it's true because dollar has depreciated and euro has appreciated. This is true, right? This is the option actually. Now what? The euro will buy fewer European goods. Euro, no, it's not like that. The euro will buy fewer US goods. I didn't say about the goods anything. So then the euro depreciate against dollar. Euro depreciate. No, euro has appreciates. Okay, understood? So this is the option. A dollar depreciate against the euro. In upcoming questions, I'll try to connect this information also, like how exchange rates can affect the goods, or maybe in the upcoming lecture sometime. We have trade related factors also. So option is correct here. So we have another question now. Okay, try to understand here. Another question we got here. An appreciation of the US dollar against Japanese yen. For example, what does mean by they are not telling you here it's which currency is your currency. No. So they're saying appreciation of US dollar against Japanese yen. So we can create a scenario. For example, previously $1 was equal to 6 Japanese yen. For example, previously this was the rate previously. Now what happened? Because you have to increase the US dollar. You have to appreciate the dollar against Japanese yen. Now what? $1 equals 10 yen. This is what in this scenario, because if you will compare these two rates, yen has depreciated. Why? Because previously you were paying 6 yen to buy $1. Now you have to give 10 yen to buy $1. It means yen has depreciated and dollar has appreciated. And now you have to see what is the correct option. They are saying an appreciation of US dollar against Japanese yen. Okay, what would increase the cost of buying supplies from US firms? Increase the cost of buying supplies from the US firm? Okay, think now this way. Let's assume you are living in Japan. Okay, Japan. Now what? You bought a goods and you have to make payment of $1,000. You have to make payment of $1,000. Okay, you are living in Japan. So what? If rate will move this way, so previously, as per previous rate, so you have to multiply by 6, you have to give 6,000 yen to buy $1,000. But now, okay, you have to give 10 yen to, it means you have to give 10,000 yen to buy $1,000. Understood? So tell me what happened here. Increase the cost of buying supplies from US firm. So your cost will increase or not? Check it here. Previously at per previous rate, so you to buy $1,000 only you have to give 6,000 yen. But now you have to give how much? 10,000 yen. So tell me your cost of supplies has increased or not? What do you think? Just think. Just think because I'm giving you time to think about it. And I have given you the example also. So first option was what? First option was what? Increase the cost of buying supplies for US firm. Okay. Actually, no. This option is what? This I have misinterpreted here. Increase the cost of buying supplies for US firm. Okay. You are not living in uh, Japan. You are living in US because it's for. I was thinking from US firm. Okay. Now I have to change the story. The story is rate has moved like that. Okay. Now assume you are living in Japan. Oh, sorry. You are living in USA. Okay, you are living in USA. I have to change the story now. For example, previously you are living in USA. So if you were giving $1, so you can get 6 yen. Now you can give $1 and you can get 10 yen. In this scenario, the yen has depreciated, dollar has appreciated. That's great. Now, for example, you bought some goods, okay, from Japan. You are living in USA, so you have imported some goods from Japan. From Japan. And the price is fixed in Japanese yen, and the price is how much? 10,000. It means you have to make 10,000 yen, payment of 10,000 yen. Now what? If rate is $6, so 10,000 divided by 6. So just you have to divide how much yen it will be. Let me see on calculator. Because now you have to pay yen. So it means yen you need to buy. And if rate is 6, for example, as per previous rate, so 10,000 divided by 6. So it means you have to pay 1667 rounded figure. Okay, dollar to this much to get this much yen. But now if the rate will move to this $1 equals 10 yen. So again, payment is fixed in yen, which is 10,000 divided by 10 because now rate is $1 equal 10 yen. So just you need $1,000 to buy. So tell me for you, goods became expensive or cheaper if you're living in USA? As per previous rate, you need to spend 1,667 yen to buy 10,000, $1,667 to buy 10,000 yen. But now you have to buy only you have to give only $1,000 to buy 10,000 yen. So it became expensive or cheaper? Cheaper for you. So this is incorrect. So increase the cost of buying supplies for US firm. No, it will not increase. It will decrease actually. Okay. Yes. So this is incorrect. Again, second, if appreciation of US dollar against Japanese yen would what? Make, here we go. Make travel in Japan more expensive for US citizen? No. If you are US citizen, so now you will give only $1 and get 10 yen. Right? Previously, you have to give $1 and you are getting only 6 yen. So it will become expensive, poor for you to go to Japan? No, it will not become expensive. It will become cheaper for you, right? Because you have to give few dollars and you can get more yen. Okay, because you are going to tour the Japan, right? You are going to visit the Japan. You are going to explore the Japan if you are US citizen. So by giving now, if this rate will move like that from 6 to 10 yen, so it will be good news for you. So this is also incorrect. Make travel in Japan more expensive? No, less expensive actually. Not more expensive. Incorrect. Then what? Third option we got. They're saying increase the translated earnings of US subsidiaries domiciled in Japan. It will increase. For example, it's like that if you are living in USA but you have business in Japan, and for example, you got a profit of 10,000 yen in Japan, and now this profit you want to bring to USA. So your remittance will increase or decrease. Previously rate was 6. So you will get 1,667 yen because 10,000 divided by 6. So this much dollar you can get, right? For example, if you have a profit of 10,000 yen in Japan, and if the rate was 6, so you will divide with the 6. So it means this much US dollar you will get in the USA. But if rate will move from 6 to 10, you will get only $1,000. So your earnings will not increase, it will decrease again. Again, this also option is incorrect. So that's why I told you appreciation depreciation is really important. Now our option D, obviously one option is left, that should be now correct. Make US goods more expenses to Japanese consumer. Yes, it is very true. How? For example, now for Japanese consumer, let's assume now you are living in Japan because you are Japanese consumer, assume now. So you are living in Japan, your currency is yen. Now you bought goods. You bought goods from USA. And you have to make payment in dollar, $1,000 payment you have to make. You are living in Japan now. If rate is 6, if rate is $6, like $1 equals 6 yen. So what? To buy $1,000, you have to give 6,000 yen. Right or wrong? To buy. But what if rate will move $1 equals 10 yen? So to buy $1,000, you have to give 10,000 yen. To buy $1,000, you have to pay 10,000 yen. So tell me, yes, what will happen here? Makes US goods more. Yes, goods will become more expensive for you. Previously, it was costing you 6,000 yen. Now it will cost you 10,000 yen if you're Japanese consumer. So yes, makes US goods more expensive to Japanese consumer. Correct. Okay, guys. Another question, because it's really important to understand. Here we go. Now we have another question on your screen. The question is they're saying if a consumer in Japan, okay, you are living in Japan again, decided decide they would like to increase either purchase of consumer products made in United States. It means you are importing now. You are living in Japan, your local currency is yen now. Your local currency is yen. And you are importing goods from USA. This is what is the scenario from USA. And if you are importing goods from USA, it means you have to make payments in USA, in US dollar. Okay? Okay, now what? If a if a consumer in Japan decide that they would like to increase their purchase of consumer product made in USA, in a foreign currency market, there will be tendency for what? Because you have to make payment in dollar, right? Because you are importing goods from USA. If you have to make payment in dollar, so we need to buy dollar. If you will buy dollar, obviously dollar demand will be created, right? Dollar demand will increase because you have to buy dollar to make payment in dollar. So dollar demand will be created in Japanese market. So what will happen here? Demand will be created. So they're saying the supply of dollar to decrease. No, we will not say the supply of dollar to increase. No, so it is the demand for dollar, not the supply. The Japanese yen to appreciate in value. No, it will depreciate because you are buying dollar. When you will buy a dollar, dollar demand will be created, dollar will be appreciated, and Japanese yen will be depreciated. So here they're saying Japanese yen to appreciate. No, it will depreciate. Okay. Then the demand for dollars to increase. Yes, it is correct. I hope so it is clear. And then what we got here. Okay. Another currency, another question actually. Okay, guys, this is actually a question, but there is nothing is explained in your book regarding this, whatever I'm going to tell you now. So please remember, I will tell you one formula. Okay, this formula you can use in certain situation like this. So what is the situation? So here we go. This question. So they're saying if the annual US inflation rate is expected to be 3%, this is the inflation rate in USA. In USA. Okay. And Potomanian Potama is expected to depreciate against US dollar by 12%. For example, they're saying there's inflation in USA, but in Potama, okay, Potama is going to depreciate against US dollar by 12%. So it means there's inflation in USA, but Potama currency is also depreciating by 12%. Now, a Potomanian firm importing from the US, okay, we are importing goods from the US. It means we have to make payments in USA. US dollar. The parent can again a Protomanian firm importing from its US parent say we have one parent company in the US, so we are importing goods from there. Simply we are importing goods from USA. Can expect the Potama cost of imports denominated in dollars too. This is the question. Go through one more time question. They're saying that we are buying goods from the USA and there is the inflation in the USA by 3%. And there is another information that our Potomanian Potama is depreciating by 12%. If still in this is the scenario, if we are importing goods and there is inflation in the USA from where we are importing goods, but our currency is also devaluing. So they're saying that the cost of imports denominated in dollars, it will increase or decrease in percentage. This because you can see your options are available in percentage. The import cost or the effective cost of goods will increase or decrease. So guys, whenever this scenario is there, so you have to apply this formula to get the increase and decrease in percentage. And the formula is, so when we want to calculate effective, I'm just writing here, this is the formula. Whenever you want effective increase in cost, so this formula you will apply 1 plus US inflation rate divided by 1 minus Potama depreciation rate. Please, because Potama currency is depreciating. If Potama currency is appreciating, this formula will be modified. 1 plus will be here Potama appreciation rate. But our Potama currency is depreciating. So if depreciation is there, so you will take 1 minus Potama depreciation rate minus 1 and multiply by 100. You will get the answer in percentage. Now let's apply the formula. So 1, this formula, so numerator. 1 plus US inflation rate. So 1 plus inflation rate in US is 3%, which I can write 0.03. Divided by 1 minus Potama depreciation rate is 12%. I'll write 0.12 minus 1 and multiply by 100. So let's solve the numerator denominator. Numerator will be 1.03. Denominator will be 0.88 because 1 minus 0.12 will be 0.88. Okay, you will solve, divide and minus 1 and multiply by 100. And your final answer would be almost 17.05%, something like that. Okay, so this is what is the answer. So our cost will increase. How it will increase? Um, you should not select the option with the decrease. No, 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 not decrease. It will increase. The reason, because first there is inflation. This is the sign for increase in the cost. And second thing, your currency is devaluing. This is another sign that the cost will increase because your currency is devaluing, right? So you have to give more money to buy a foreign currency, right? So this is another indication. So cost will increase. But if there is an appreciation in your currency, then cost may decrease, but your currency is being depreciated here. Understood? So first option is correct. Okay. I think so. You can just cross check the answer, what answer you got. So yes, first is correct. 17% is the rounded figure. We got another question here on our screen. For example, they are saying that try to understand, please, this question carefully. Okay. They're saying that suppose that Swiss wrist watch is priced in Swiss francs. Okay, this is Swiss francs is, let's assume, Switzerland currency. We have wrist watches. Yes, their price is in Swiss francs. Become very popular among US consumer. Okay, first understand here. First sentence you have to understand. Let's assume US consumer means you are living in USA. You are living in USA and dollar is your local currency now. Okay. Now what? Foreign products are very famous in your country. Let's assume this is the first sentence, right? Foreign wrist watches are very famous in your country. So you are buying wrist watches. Okay. But their price in Swiss francs. So what you will do? Obviously, you need to buy Swiss francs, right? Swiss franc you need to buy. If Swiss franc you need to buy because you are living in USA, you are buying watches and watches prices in Swiss francs. If you are buying watches, because watches are very popular among US consumers, if you are buying watches and you have to make payment in Swiss francs, so what will happen? You will buy Swiss francs. So what will happen? Swiss franc demand will increase. And if demand will increase, so Swiss francs will appreciate against dollar. This is the first conclusion of the first statement. Second, now you have to understand second. They're saying that while, this is another statement, while Britain experiences a relatively higher inflation than United States. Now here we have a pound versus dollar. Okay, and in uh, British, in pound, we have a high inflation. Inflation is high. Please remember rule for the inflation. Any country where inflation is high, if inflation is high, so remember this statement. If inflation is high, so please that currency will depreciate. That currency. For example, if inflation is high in UK, so UK pound will depreciate. If inflation is high in USA dollar will depreciate. So what is the question here? They're saying while Britain experiences relatively higher inflation than United States. It means here pound will depreciate. It means second statement is the first answer for the first sentence is what? Swiss franc will appreciate. And in answer for second statement is what? Pound will depreciate. Now we have to look at the question. Assuming that all other economic parameters remain constant, which one of the following statement is most accurate? The most accurate statement is what? Swiss franc will appreciate because it's in demand and British pound will depreciate against dollar because there is more inflation in the British pound. Here Swiss francs will appreciate against dollar. Here British pound will depreciate against dollar. So here we have to check the question where this option is written. The US dollar will depreciate relative to Swiss francs. Yes, true. Because Swiss franc will appreciate against dollar. This is true. So they're saying Swiss franc will appreciate against dollar or dollar will depreciate against Swiss francs. It's the same thing, right? Second, appreciate and again US dollar appreciates relative to British pound. Yes, because British pound will depreciate means the US dollar will appreciate. So this is the correct answer actually. Okay, option is the correct. So we don't need to go through other. Understood, guys? This is how the question will be tested. Now 18.3 topic is tested, is completed 8.3. So please remember, I am just changing some sequence here because some information is not available in your book. So I'm adding that information. Okay. And I'm telling you those things. If, by the way, as per book content, so we spent last lecture we spent last time 1 hours and 20 minutes, 1 hour and 20 minutes, and today we spend almost more than 1 hour or maybe 1 hour. So now we just finished 18.3 as per your book content. This topic is over. Now you can go through all the questions, and next class will start uh, 8.4, topic number 8.4. Okay, we'll discuss in the next class. Thank you so much, guys. If you have any question, you can ask.